Hello guys, welcome again to Jugos FX. Today we are going to be talking about phase 3. Okay, remember I said this course is, this particular phase 3 is the most important part of this training, which means that it's like the core of it, okay? Once, if you get lost, if you miss this particular stage to understanding, then it'll be very hard for you to continue with the lessons because most of the things that we'll be doing now, we're going to be referring it to this particular phase, all right? So with the knowledge of this phase, it's the knowledge we're going to use to integrate all other phases that are still ahead of us, okay? So to this phase, phase 3, we are going to see the main topic of the phase is institutional order flow. So we're going to see what is institutional order flow. We are going to see what is market structure. We are going to see uptrend, downtrend, ranging markets, and then 3B, you're going to see order blocks, right? So these are like liquidity blocks, bullish order block, bearish order block, mitigation blocks, and so on. Okay, so that is it. Let's get to the Discord server and then see what is there. So here we are, phase 3, institutional order flow. So let's first of all start with defining what institutional order flow is, so that it will help you, it will ease you to be able to understand what I'll be saying. Okay, so the order flow trading concept simply seeks to indicate the directional bias of the market, where big participants, these big participants I'm talking about, they are the interbanks, they're the big banks, all right, world banks, all those things, like Bank of England, Bank of Canada, all these are people that have huge sums of money in the forex market. Okay, so where the big participants will manipulate price to go to, and then resting liquidity pools will be targeted on previous highs and lows in form of stop losses or pending orders. If the price collects liquidity on previous lows, this means we might see the market structure being bearish. Retail traders use order flow for directional bias. For example, looking at this picture, we talked about liquidity already, right? So, which means that looking at this picture, what you have above here is called buy side liquidity, and buy side liquidity. And remember that in that particular video, the video of liquidity, I told you that the market is always looking for liquidity. As simple as that, the market is always looking for liquidity. Now, institutional order flow here comes in to tell you which direction of liquidity the market is looking for. Okay, so if the market is looking for sell side liquidity, what is down here? We have sell stops, we have stop losses for the buy orders, right? So if the market is heading for the sell side liquidity, we are going to see the institutional order flow for the market is bearish, which means that the market will just be seeking for sell side liquidity. As it's going up, it's coming back for sell side liquidity, clearing. You continue clearing sell side liquidity until the institutional order flow changes. Now, just quickly going to the charts, you will show you that all this while on the Euro USD, we have been on a bearish institutional order flow. All right, this is the chart of the Euro USD. Now, if you look at this chart, you will discover that the market has been seeking for bearish for sell side liquidity ever since. Okay, that's even starting from 2021. Okay, the market has been seeking for sell side liquidity ever since. This is the daily time frame, you understand? So since 2021, the institutional order flow for the market has been bearish for Euro USD, which means that here the institutions have been net short. All right, they are selling this particular currency. Since they have a lot of money, the market is going to follow their direction. And if you stand against them, it will be like you want to stop a moving trend. Why? Because they have a lot of money. Okay, put it in this case like you want to sell something in the market and a very big person, rich person comes to buy it. All right, you might say, okay, the thing is 10,000, and you might want to say that it's 50,000. The person can even give you 100,000, right? And you go home with the thing because he has that money. He has that, he has that balance, all right? That he can even buy, and then, even that you some money. You understand? That's how the institutions function. They control the market because of the capital they have. They determine which prices an asset can go to. Okay, if the institutions they enter buy positions here, nobody is going to stop it because their investments will have to push price up. Why? Because maybe let's say in the 7 trillion volume a day, retail traders don't even have up to billions of it. Okay, which means that the highest volume of it is coming in by the institutions. If you go back to market participants, I gave you the hierarchy of the market participants. All right, the first people, the interbanks, they are the people that have the highest sum of money, and they are the one pushing this market. All right, remember, like I said here, that if here I said the order flow trading concept simply seeks to indicate the directional bias of the market, where big participants, these big participants like the banks, will manipulate price too. Remember, I said if they want to sell, they'll manipulate price down, right? The term coming here as manipulate is to tell you that if they want to sell, they will need people to buy from them. And to need people to buy from them, they have to manipulate those people, okay? They have to manipulate those people to buy so that they will now start pushing price down. You understand? Because normally in a market, only one participant cannot push the market to any direction. You need buyers and sellers to be actively playing in the market. That's supply and demand, right? If you go to the market to sell somebody, there's nobody there to sell. I mean, the market will not function. That's how it is. So in the Forex market, there are always buyers and sellers. And for the institutions to take price to a particular direction, they need people to stand against them. They need counter traders. All right. So that is why institutional order flow is very, very important here, which means that you have to study it so deep that you have to be flowing only with the direction of the institutions. Okay, if you stand against them, they're going to buy all that you have and even hit your stop loss, right? If they are selling and you are buying, they're going to sell to you at a very high price that you buy, and you will not have money in your account again. All right. So that is how this is the main purpose of this concept, to teach you how to follow the direction of the institutions. Okay, to know where price is going to and why price is going to that particular area. Now, looking at this level here, when price took this low, when price took this sell side liquidity, went up, did not take this one and started coming back down, I will already know that whatsoever price does is going to come for this low. You understand? So you see price came back down and clear it. Why? Because this is already a bearish institutional order flow. The market has shown to me that it's looking for sell side liquidity. Why? Because it left from this level, did not come to clear this liquidity. Instead, it came back down, took the sell side liquidity. That's a signal that the institutions are selling. All right, they are looking for sell side liquidity. They are looking for the money that is sitting below these lows. All right, there are traders that are sitting here, and those are the people that the institutions are coming for them. All right. So that is the meaning of this particular issue. The main reason why I keep insisting that you need to make sure you concentrate very well concerning this particular topic. Okay, there are elements under this institutional order flow. Okay, it's not like a single topic. There are a lot of things, like I gave you from the PDF notes, order blocks and all those things, bullish and bearish market. Those are the things that are coming under this institutional order flow, which are very, very important. The first thing is for you to know where the market is going to. That's your directional bias. And then now the second thing, now you now look at market structure. All right. So let's just look at this take away keys. Look for now, if you want to know your directional bias or the institutional order flow, you first of all have to start with a higher time frame, because these institutions, they trade mostly on higher time frames. Okay, they trade mostly on higher time frames. They have a lot of money. They don't have that time to be looking at 1 minute time frame, 2 minutes time frame, and all those things. Okay, I don't know if I've talked about time frames yet, but we'll talk about it if I haven't talked about it. Okay, so these institutions, they trade from higher time frames, yearly, monthly, right down to the 4-hour time frame. Okay, so looking at your institutional order flow, you have to first of all start with the higher time frames, which is the monthly time frame and the weekly time frame. Very, very important. Those are the time frames that you have to start with them: the monthly, the weekly, and the daily time frame. Okay, those are the time frames that you are going to use to be able to identify your directional bias. Now, if you're a scalper, you will still have to use higher time frames. Like you're a scalper using 1 minute, 5-minute time frames, you will still have to use a time frame higher than those time frames that you're using for your setups and your entries, which is going to be like your higher time frame bias. All right, it's very, very important. So that is the lecture for institutional order flow. Now, all these things that I'll be doing now, I'll be doing it, incorporating it with the order flow. Okay, so let's start with market structure. What is market structure? Now, market structure is a behavior or condition or and the current flow of a market. All right. It highlights support and resistance levels, swing highs and swing lows. A turn, a trend is simply a consistent direction of price movement over time. All right. Market structure can tell you if the market is trending or not. Now, this is simply the meaning of what I'm saying there. Now, this is a market structure here. This market is trending down, right? That's the purpose for market structure. If you don't know market structure, you will not know that this market is trending down. All right. So above here, we call it, this is a swing high. These are swing high, swing lows, swing high, swing lows, swing high, swing lows. Now, if the market is making these swing highs and swing lows in a bearish way or going down, that's the institutional order flow is bearish, like I said, and it is called a bearish market or a bearish trend. All right. Now, we are going to do something right away. Let me just, I don't know if I should remove all drains. No. Okay, so I want to draw something here. For you to be able to identify that the market is trending down, excuse me, if the market is trending down, you have to see the market doing something like this. It should be it creates a high, creates a low. This is called a lower low. Why? Because it's lower than this and it's lower than this. Now it comes up to around this area. Now this is a lower high, right? Because it's higher, but it's higher than this one, but lower than this. So this is a lower high, a lower low, lower high, lower low, lower high, lower low, lower high, lower low. Okay. So now this here is, I'll just abbreviate it. Lower high. No, let me put it down. Lower high. That's a lower high right there. And this is another one. The best way to name it is just to put L-ish, right? Okay. So, and let me just quickly cancel. This one now is lower low, lower low, right? So this is a case of a downtrend. This is a case of a downtrend. All right. Oh my God, what is that? Lower low and then a lower low. This is lower than this and this, so it's a lower low. Now all this here is called a downtrend. All right, that's a downtrend. Down or bearish trend. Down or bearish trend. Okay, make it a little bit 20. Down. Sorry about that. Down or bearish trend, right? This is a down or bearish trend. So how do we spot an uptrend? If the market is creating this high is higher than this one, so this is a higher high. And then now this is higher. This is lower than this, but higher than this one. So this is a lower high, right? So price makes a higher high, makes a lower high, higher high, lower high, and a higher high. So at this case here now, this is what we call an uptrend, all right? Higher high. That's a higher high right here. And then higher high, higher high. This one now is a higher low, higher low. It's higher, but lower than this one. It's higher, but lower than this. So that's what we call a higher low. All right. Remember, I said if you want to abbreviate it, you can just put HL. All right. So this here is called an uptrend. This is an uptrend. Let me bring it up a bit. That's an uptrend. Uptrend or bullish trend. Uptrend or bullish trend. All right, that is it. Now we have three types of markets. All right, we have a downtrend, we have an uptrend, and we have a ranging market. In a ranging market, price is not creating swing highs or swing lows. It is moving in a tight range. It's moving in a particular tight range, creating just highs and lows, right? It's not breaking any previous high or whatsoever. This is called a ranging market. Price is not going to any direction. So this is a ranging market. Ranging market. Okay. So this is a ranging market, and this is our downtrend, this is our uptrend, right? In a ranging market, it's actually going to no direction. Here, I will give you the reasons for a ranging market. And then now, looking at an uptrend here, I've said if you see price, now you will see, to determine an uptrend, you have to see price breaking structure. What do I mean by breaking structure? Price comes up, it breaks this higher high, all right? It creates a higher high, it comes back down, comes back up again, and breaks another higher high. So with this information, this gives you the idea that the institutional order flow here is bullish, all right? The banks are going long, right? The banks are bullish, they are buying, their investments are buying, okay, on this particular asset. Now, if for you to determine the market, if a market is bearish, is when you see price creating breaking lower lows and creating lower lows. All right, it breaks a lower low and then it creates a new one. All right, it breaks a lower low again, creates a new one, lower low. So this breaks here is called BOS, break of market structure, or whatsoever you can put it. Break of market structure, that's BMS. All right, BMS, I think you have been seeing that on my chart. So with this in mind, let's just quickly look at this. I don't know, let me see. So now, if I look at this area here, this is a downtrend. It's very obvious, right? This is a lower low. This is a higher low. I mean a lower high, another lower low, lower high, lower low, lower high, lower low, lower high. I mean, it should be very obvious, okay? You don't squeeze structure. You don't squeeze structure in the market. Now, if you just look at this, you will discover that this was an uptrend, and then this is a downtrend. As simple as that. You just need to see price going up or coming down. If it is doing neither of these things, then it should be in a range. All right, you call it a ranging market. Okay, so let me see. Is that? Let's go back to the Discord. So we have already talked about types of market structure. Remember, I said market structure is the behavior or condition or and the current flow of a market. All right, where is the direction? Where is the flow? Where is the market going to? Is it creating higher highs or higher lows? Now, looking at this picture, this is a downtrend, right? The market is breaking lower lows, creating lower highs, breaking lower lows, and so on. So this is a downtrend. All right. Remember with the picture we talked about sell side liquidity, most of you are marking trends, right? Either an uptrend or a downtrend. I think you know what that means now. Swing highs and swing lows. All right. So now types of market structure, but we say it is useful to be able to identify the different types of market conditions, as this can help you make trading decisions such as in which direction you should trade or which particular strategy to use. Now, in an uptrend market, you only buy, all right? You don't sell in an uptrend market. If the market is going up, you are just looking to be buying. All right, you are just looking to be buying, no selling. And now, if the market is going down, you are looking your only job is to look for sell opportunities. You are not buying, because if the market is dropping, it is the institutions pushing the market down. The institutions are selling and you cannot do otherwise. You just have to be selling as they are selling as well. Okay, that's the thing. All right, so trending market. A trending market is when price is clearly moving in one particular direction. If the price is moving up, then it is said to be in an uptrend. If the price is moving down, then it's said to be in a downtrend. As simple as that. Many traders trade in the direction of the trend because there is a high probability of trade being profitable. If you go against a trade, you are going against the big institutions, and I believe you cannot stand against them. Now, take this part, this phrase, all right? In the forex market, they always say the trend is your friend, all right? The trend is your friend, which means that, I mean, if you have a friend, it's a good friend, you should be moving with that friend side by side. You don't leave their friend, or you don't betray their friendship. Okay, so the trend is your friend. If your friend is going left, you should be going left, right? Going right, you should be, I mean, what are friends for, right? So you don't stand against your friend. You don't betray your friend. Okay. You don't betray the trust of your friend, like I put it. So the trend is your friend. Remember that particular phrase. You don't want to ever trade against your friend. All right. I mean, if you trade against your friend, it means that you have bad friendship habits, right? It means even on the physical, you cannot have a good friendship. Okay, so remember that if you trade against the trend, you are actually a bad person. You cannot make good friends even in real life. All right. So a trend is your friend. Always trade with your always follow the trend. If it is bearish, you'll be looking to sell. If it is bullish, you'll be looking to buy. If you go against it, you are going to lose your friendship, and losing your friendship in forex, which comes, you are going to make losses. All right, you're going to lose your money. So entering the trade when a trend is beginning to develop means it is most likely to return a profitable. Now, talking about this one, it doesn't mean that if the market is in a bullish trend or uptrend, you should go and buy right at the top. No, I'm going to I'm going to teach you on how to identify trend reversals. All right, meaning that if the market is going down, it's not going to go down forever. So I'm going to teach you how to spot reversals. Okay, how to spot reversals. If the market is going down, you should be watching. If it gives there are signals that the market will give you that the structure is changing, and when the structure changes, that's where you early buy. You buy at the lower price. You don't go and buy when prices far right up. Okay, you buy at a lower price, and as prices is going up, you are making profit. All right. So a trending market is when prices is clearly moving in an uptrend or downtrend or downtrend. So let's look at an uptrend here. I had a picture of that. So you see here, the market is going up, creating a higher high, higher low. This is another higher high, H, double H. This is a higher low, higher low, higher high, higher low, higher, that is higher high, higher low, and so on, right? You see the directional bias is bullish. So what is above this area? The market is hunting for buy side liquidity, buy side liquidity, buy side liquidity. All right, the institutional order flow, IOF, is called institutional order flow, here is equal to bullish. All right, it's positive, bullish. Okay, as simple as that. So let's see another picture for a downtrend. Now, this is for a downtrend. You see the market creating the market is breaking lower lows, creating new lower lows. It breaks again, it creates a lower low, breaks. I mean, it continue creating lower lows. All right. Remember, the market will not go down forever. We are going to talk on how to spot reversals. This is a lower high, lower high, lower high. I mean, this is a downtrend, which means that the directional bias here is bearish. The institutional order flow, IOF, here is equal to bearish. Okay, here is bearish. Okay, so this is your friend. Your friend is going down, which is your trend. You don't go against your trend, all right? The trend is always your friend. Okay, so looking at a ranging market, this is what I mean. It's actually not going up or coming down, all right? It's just stagnant in a particular range. It's neither going up or coming down. Okay, so now let's talk about corrections. Now, a correction sometimes referred to a retracement. It's a retracement. It's when the market moves in the direction of the trend, but gives us a pulse back for a short time and then continue or in the original direction. Now, looking at this picture here, this is what we call corrections. All right. When the market expands down and then trades back in the opposite of the direction, then continues, it goes down, it goes back up. This is what is called correction or retracement. Any move opposite to the original direction, the market is going down, right? The market is going down, creating lower lows, and then these corrections, the market pulls back. This is called a pullback or a retracement or a correction. All right. So, which means that if you sell here and the market is going down, for you to add more selling positions, you'll be waiting for a retracement. It gives you a retracement, you sell again. It goes down, gives you a retracement, you sell again. Goes down, gives you a retracement, you sell again. All right. You don't sell here. You wait for price to give you a retracement first before you sell. Because sometimes you might come while the trend has changed already. So what will you do? All right. You wait for a retracement. All right. And then you sell. You wait for a retracement, you sell. You understand? That's how it is done. Retracements and corrections is the same thing. Okay. So a correction, like I said, it refers to a retracement. It's when the market moves in a direction of the trend. So let's quickly look at how we can spot if a trend is changing direction. Okay. Now, looking at this level here, you will discover that the market was bullish, right? Remember I said, look for structures that are very obvious. Okay. You try to zoom out so that you see a tiny chart like that, so that you will not pay attention to some little structures in the forex market. You get it? So at this level here, the market was pushing up. This was an uptrend. How will I know that this downtrend has started? How will I know that this downtrend has started? Now I want to see, this is a lower low, I mean a higher low. This is a higher low, right? It is higher than this one. So from here, for the uptrend to have continued, we'll be waiting for price to create a higher high, but it did not create a higher high. Instead, it creates a lower high, which is lower than this one. So now that's a signal that this trend is changing. The market comes down and it breaks this low again. All right, that's a signal that we have changed direction. So you now wait for corrections to sell, wait for corrections to sell, you wait for corrections to sell, corrections you sell, you sell, you sell, you sell, you sell, you sell until you see price not making lower lows again. Now, drawing it, this is how it looks like. The market can be in an uptrend. It reaches a certain level. It comes back down. It breaks the previous higher low. It goes up. It doesn't break this one. Then the trend has changed direction. Okay. Now, this particular reversal pattern is called the head and shoulder pattern. All right. It looks like the head and shoulder pattern. This is the head, this is the shoulder, this is the shoulder. Okay. So this is a reversal pattern. All right. If you are in an uptrend and you see something like this, know that the trend is changing direction. So you are going to be switching from buying now to selling. You don't have to be selling now again. Price has given you, you have seen price starts to break a higher low, okay, which was instead breaking but higher highs to confirm the uptrend, but it has now started breaking lower highs. And what breaks lower highs is a down trend. All right. What is in charge of breaking lower lows is a downtrend, not an uptrend. An uptrend is in charge of breaking higher highs. Remember that, okay? So if you see the market breaks higher highs, go up to a certain level, start breaking lower lows now, that's already a downtrend. So you have to change your direction. You don't have to be buying again. Now, this is one reversal pattern. You can, it's the same thing for a downtrend. The market will be going down and then it stops going down, it starts breaking the higher highs up. Okay, something like this. The market will be going down, it reaches a certain level, it comes back up and it breaks a higher low, a lower high, comes down, doesn't break this one, and then start breaking. Now a trend has changed. This is now already an uptrend. Okay, that's how you spot reversals of trend. Now remember, this is one, and then the other one is like this, which is the one that happened here. Price will be going up, it comes back up. Instead of creating a higher high, it will now create a lower high, and then now it breaks this low, starts breaking. This is now the trend reverse. This is a trend reversal. Okay, we call this move SMS, shift in market structure, failure swing. All right, it's a failed swing. Price has failed to move higher, which means that the people that are buying here, the institutions, they are changing direction. They are now selling. All right, so you have to take note of that. This is not like a head and shoulder pattern anymore. All right, it's not like this one, shoulder and shoulder on the same line. All right, so this is another reversal pattern. It's the same thing in a bearish condition. The market can be going down, it goes down. Instead of creating a lower low, now it creates a higher low because it's lower than this one. Now creates higher highs, higher highs. That's the reversal pattern. So immediately you spot this, immediately you spot price breaks this level after making this SMS, you simply just wait for a correction and then you start to buy. You wait for correction, you buy, it goes up, you wait for correction, you buy, just like that. That's how you trade in an uptrend. Right? You don't come and you buy here. If you buy here, the market will be retracing. You are going to be making a huge loss. So you always wait for a retracement. The same thing here. You don't come and sell here, even despite that it's a downtrend. You wait for a correction and then you sell, right? So we are going to go deeper and you'll see reasons why here particularly you should wait for a retracement to come and reach. Because in a downtrend, sometimes the corrections or retracements are not going to be the same. Okay, you can see something like this now. Why this one is not as heavy as this one? Okay, so we are going to see reasons or places where price likely reverse from after this retracement, so that you will know that if you want to sell in a retracement, this is where you'll be waiting for price to come to before you sell. So this was a reversal pattern here. It created an SMS movement, all right, SMS or field swing, okay, and then the train change direction. Okay, it's very simple, guys. It's very simple, very simple. Look at this one. This is a head and shoulder pattern. Remember I said you don't over zoom in price until you'll be seeing a lot of swing highs. This is a shoulder here, this is the head, and this is a shoulder. What happens? An uptrend starts. This is a shoulder here, this is a head, and this is another shoulder here. What happens? We have a downtrend. All right, now what happened here? We have an SMS. What is that? This is a field swing, right? An uptrend. As simple as that. Is very, very easy, guys. Very, very easy. You just have to be able to, you just have to master it, and then that's all that you need. All right, that's all that you need. That's really all that you need. There is nothing to complicate here. Nothing to complicate. Okay, always look very well. Either the price will reverse. Look at this, very, very clean. All right, we have a shoulder here, we have a hit here, and look at this shoulder on the same line. That is what I mean. All right, on the same line. Once you see this and price comes up and then you break structure here, it breaks this. Now this has created now a higher high. All right, it has created now a higher high. All right, now what do? You simply just wait for price to come back to retrace, then you shoot your buy. Shoot this, you are making $200,000 immediately. All right, so that is it. Back test it. We are going to, in the next lesson, we're going to go into other blocks, bullish order blocks, bearish mitigation blocks, and the breaker blocks. All right, so see you guys in the next session.